said that you're not a big buyer of this China capex recovery theme, but you think the market's overestimating it? Because you look at the rallies in some of the steel companies, etc. They seem to be building in a lot of optimism 6 months out even.
Yeah, I mean, I think look, we are definitely not, getting excited or tempted to play these rallies. I think, one idea is not to. I mean, if you don't believe into it, we would not do it, even if stock prices are going up like 30, 40, 50% for some of the steel names.
Why do you believe that this story is overhyped? Do you think another shock is coming from China sooner or later?
Yeah, I mean, clearly we think so. There are plenty of statistics around it. I mean, if you look at this whole China growth model so far, I mean, their debt to GDP has sort of gone up like 100 percentage point in the last 7-8 years. And guess what? I mean, it's at 260% of GDP. I mean, the so-called total social financing. But there are people in the market, economists, more learned people who say it does not have all of the debt. So it could be a higher number. And even if you assume it's 260%, it's rising 300% of GDP in 4 or 5 years' time. So directionally, it's heading in the wrong way. Now, when would that large shock come in? I think probably it's no one particular date, but you would see sort of readjustments happening every 6 months or so. And eventually you will end. I mean, it's very difficult to make money on a sustainable basis, if you are backing these names.
You are underweight China in your overall Asia book?
Well, yeah, in our overall Asia book, we are underweight China. But now, since we're talking China, there is one sort of, say, capex-led China or old China, all these sort of steel mills and, industrial infrastructure sort of, names. But then there is a new China, which is consumer-oriented China, and consumption in China has been lagging, and, everyone sort of knows that. Investment is sort of, it's an over-invested economy. So there is a tailwind for consumption, and I mean, there's a case to be made, for consumer stocks in China. These consumer stocks could be, consumer discretionary sort of names. As income level rises, people would travel, medical facilities. So there's a investment case to be made for healthcare in China. So all those sort of names are still interesting. They are expensive, but then again, you have to be really sure, what you're getting into. But there are opportunities, I would say. I mean, there's another large opportunity in China, which is natural gas consumption. It's a relatively cleaner fuel than coal, etc. Prices are down now. If you compare coal to natural gas, just on a calorific value basis, after accounting for all the efficiencies that you can get in a gas plant, I mean, gas is not too far away from coal, and it's a scalable sort of a model. So, gas utilities could be interesting name there. It fits into the pollution control theme of government. You don't want to be burning too much coal, and it's a nascent sort of business which can grow rapidly.
Are you buying, talking of capex recovery, are you buying the capex recovery theme in India? Because this quarter, a couple of the results have raised hopes that maybe private capex is recovering. Is it too soon to say that?
Yeah, probably it's too soon to say that. I mean, another way to look at it is, if you look at the banking credit to industrial consumers in India, I mean, that's flat year on year. If you look at banking credit to small and medium enterprises, it's down in absolute terms. So yes, I agree. We've seen sort of orders coming in, but then you can't execute orders, without borrowing from banks. So some more evidence is probably needed for you to buy into this capex recovery theme.
So industrials is not an area you're terribly bullish on in India.
No, but then there are industrial names which are very bottom up, and sort of say niche industrial names is something that we are happy to look at, and that is because operating leverage can play out significantly. These are some of the companies where they have set up capacities. They are sort of number one or number two player in what they are doing globally, and I mean, that's the reason to be bullish about some of these names. Like if the utilization levels are 50-60% as of today, you have massive headroom for operating leverage to play out. So we would be happy looking at those names.
What is your avoid list in India on any count, whether it's because the sector is not growing or valuations are ridiculous or managements are not clean? What is that subset of stocks where you don't want to go down that path at all?
I mean, look, as I was telling you, we own very little number of stocks in our India book and global portfolio. So by definition, we have sort of avoided a lot of names. But I mean, look, and it's difficult to say which sector. I don't want to label a sector as a bad or good. But
like you said, commodities is something that you're not terribly.
Yeah, commodities is something we are. I mean, on a global basis, we are not very keen on commodities. So that goes again for India as well.
What is your best vehicle to play the consumption theme in India? Is it through FMCG style companies or through other areas like autos or paints and those kind of areas?
I think paints is a good sort of example where the pricing power is still in the hands. It's not really like everyone is everyone can jump into. Entry barriers are sort of high for a large paint company. So that's a good example. I think companies are well managed. Valuations are what they are, but then at least you can justify some companies on a discounted cash flow basis. Okay, let's rule out next 1 or 2 or 3 years. But then if I really looked at it on a long-term basis, has it really gone berserk in terms of valuations? So the answer is probably no. So paints is a better way, I guess. Autos. Not very. Probably there are 1 or 2 names that we are sort of interested in, auto names in India, but these are more of a global plays than pure domestic plays. FMCG, again on a selective basis. I think. This is one sector where probably I would be happy to look at some sort of a special situation and not really looking at as we were discussing about banks buy just the best quality, but in this case you can look for some special situation case as well.
You're a hedge fund. You pick stocks, but you sometimes also hedge your positions by taking counter positions on the index. So yes. Do you think most emerging markets bottomed out in the month of February or late January with that big fall after which the rally has happened? Or would it surprise you if those levels were revisited in the course of the next 6-9 months?
No, that would not surprise me. I think, it's again, the levels that we saw in Feb or March, and again, a similar sort of a fall we've had in August last year. These are all macro events, and the stock price of a good or bad company, all of them fall. A good company has not done anything bad for its stock price to go down 20%. So that's my opportunity there. But then, would I be surprised? Answer is no, because there are. And the shocks would probably come from our neighbors.
I think those risks still remain. They have not.
Yeah, no, they still remain. What has really changed in China is credit was a problem. If credit was a problem in Feb, it's a bigger problem today. You've done more credit. They're all stimulus-led sort of recoveries or rallies, as they call it. You are just growing the problem bigger. I think currency is another issue that we didn't speak about. China's currency policy has been sort of a bit bizarre, and we don't really understand it that well, but. There's a time when they want to follow a peg. There's a time when they say we want to be market driven, and then they reverse this, decision very quickly. And then now the latest one is we want to follow a basket of 13 currencies, and euro and GBP and yen, etc. are a big part of it. And we know that there are, barring one central bank, everyone wants to lose on big time. So if someone is not really very bullish, say euro or yen or GBP. Then RMB would sell off as well, and if RMB sells off, then it's very difficult for any other emerging market to buck the trend sustainably. You have to follow. So just to answer it, can a shock come? Probably yes.
On that pessimistic note, let me thank you very much. It was nice talking to you.
Thank you.